Welcome to the Deep Dive, the show where we take a stack of sources and distill them into the most important nuggets of knowledge, just for you.
That's right.
Today, we're plunging into the fascinating and, frankly, pretty head-scratching world of Rigetti Computing, ticker RGTI. You see, this company just made headlines. Their stock surged, roughly 8% in pre-market trading on July 16, 2025?
Yep, big jump.
And why? Well, they announced a pivotal technological breakthrough. A mind-blowing 99.5% 2-qubit gate fidelity on their new 36-qubit system.
And that fidelity number, it's crucial.
Explain that a bit. Gate fidelity. It's about accuracy, right?
Exactly. It's how accurately the quantum computer performs its basic operations. Think of it like precision. Even tiny errors, they can snowball really fast in quantum calculations. So 99.5%, that's a massive leap.
It really is a significant technical achievement. I mean, they basically have their previous best gate error rate.
Right. And it really validates their modular chiplet architecture.
Ah, the chiplets, that's their core strategy for scaling up, isn't it?
It is. Tackling that huge scalability challenge in quantum computing, this could genuinely be a game changer for the technology itself.
It sounds like an incredible step forward. But here's the twist, and this is where it gets really interesting for investors, I think. While the tech is making these huge strides, Rigetti is still racking up significant financial losses.
Yeah, the numbers aren't pretty.
We're touching an astronomical valuation that seems completely disconnected from its current revenue, which, by the way, has sometimes been declining.
Right, a huge disconnect.
And if that wasn't enough, there's this, troubling pattern of millions of dollars in insider stock sales by the very people running the company.
Which always raises eyebrows.
So what does this all mean for you listening? Is this breakthrough the spark that finally ignites a sustainable, profitable business? Or is it just a fleeting flicker of brilliance in a, let's face it, capital-intensive furnace?
Especially when those closest to the company are selling shares hand over fist, yeah.
It creates a classic, high-risk, high-reward battleground stock scenario.
Exactly. And that's precisely what we're going to explore in this deep dive. Our mission is to unpack the comprehensive analysis of Rigetti Computing, Inc., trading on the NASDAQ as of July 16th, 2025.
We'll extract the most important insights from the sources we've got, offering you a shortcut to being well-informed about this highly speculative company. It's right at the forefront of quantum computing.
It really is.
So, with that electrifying setup, let's get into part one and start with Chapter 1, Business Analysis.
Okay.
Let's unpack what makes Rigetti tick. We'll kick things off by really understanding their core business. Remember that question we posed earlier about this being a spark or just a flicker?
Yeah.
We'll try to tackle that by understanding how they actually operate.
Right. So Rigetti operates as what's known as a full-stack quantum computing company.
Full stack, meaning what for us?
It means they control the entire technology pipeline, everything from designing and actually fabricating their quantum processors in-house. They have their own facility, Fab 1, in Fremont, California.
Ah, they make their own chips.
Yeah, all the way to building the complete quantum computers and then developing the software and the cloud services that make them accessible.
And why do that? What's the goal?
Their stated aim for this integrated model is, and I'm quoting loosely here, to provide the fastest and lowest risk path to building quantum computers that could begin to unlock a potentially world-changing opportunity.
Ambitious. Sounds good on paper. So where does the money actually come from right now to fund all this pioneering work?
Well, currently, their revenue streams are quite diversified, but also definitely in transition. A substantial portion comes from development contracts.
Government stuff, mainly.
Primarily, yeah. Multi-year agreements with government agencies like the U.S. DARPA, the Air Force Research Lab, and also international bodies in the UK. This provides a stable but often, lumpy source of funding.
Lumpy meaning unpredictable timing.
Exactly. And beyond these contracts, what other ways are they trying to bring in revenue? Are they actually selling access to these machines yet?
They are. Since 2017, they've offered quantum computing as a service, or QCAS.
QKAS.
Okay, that's through their Rigetti Quantum Cloud Services platform. So you can access their quantum computers via public clouds like Amazon Bracket and Microsoft Azure.
Got it. Integrated with the big cloud providers.
And more recently, they've also moved into on-premises system and component sales.
Selling the hardware itself.
Right. They started selling complete systems in 2021. And just last year, in 2023, they launched the Novera QPU.
The Novera. That's the smaller one.
Yeah, it's a 9-qubit unit aimed at research institutions. They actually made their first sale of that to Montana State University in December 2024.
Okay, so some early commercial traction there.
So we're seeing a company still heavily reliant on government contracts, even as they try to push into these early commercial sales.
That's spot on. The heavy reliance on government R&D contracts has been, well, a necessity. It provides non-dilutive capital, which is great.
Meaning they don't give up equity for that money.
Right. But it creates customer concentration risk. And the QCAS and QPU sales, they're still pretty nascent, quite volatile.
We saw that volatility recently, didn't we?
We did. In Q1 2025, total revenue fell by a sharp 52% year over year.
Ouch.
Yeah. And this really underscores the critical importance of their recent $350 million capital raise and that strategic partnership with Quantum Computer. We'll definitely dig into that more.
Okay. To truly understand their potential, though, we need to get to the heart of what they're actually building. What are Rigetti's core products and services?
At the core are their quantum processors, or QPUs. They design and manufacture these superconducting processors in-house.
Superconducting, like Google and IBM use.
Exactly. Their flagship system is the 84-qubit Ankaa-3. But the exciting new development and the reason for the recent stock surge is that 36-qubit modular system.
Built from smaller pieces.
Right, built from 4 9-qubit chiplets. This modular approach is absolutely key to their scaling strategy.
And how do users, say developers or researchers, actually interact with these powerful machines?
Primarily through the Rigetti Quantum Cloud Services, or QCS. That's their cloud platform.
Yeah.
It integrates their quantum hardware with classical computing resources, which is essential for the hybrid quantum classical algorithms that are common today.
So quantum and regular computers working together.
Precisely. They also provide comprehensive software development tools. They have their Forest SDK and a proprietary quantum instruction language called Quill. These let developers write and execute quantum programs on Rigetti's hardware.
So they're a pure-play quantum company focused just on this. That makes them different from, say, Google or IBM, even though they pursue similar superconducting tech.
Right. They're all in on quantum.
But where do they actually stand in terms of commercial scale and market presence? Are they a big player yet?
They are unique as a pure play, but honestly, from a commercial standpoint, they've been a bit of a laggard.
Okay.
Their quarterly revenues are smaller than competitors like D-Wave Quantum and IonQ, and their market capitalization, it's around $3.71 billion as of July 2025. That's driven purely by perceived potential, future hopes, not current financial performance.
Yeah, $3.7 billion on maybe $10 million in revenue. That's a lot of hope baked in.
Forget current profits. Rigetti's $3.71 billion valuation is a pure gamble on the future. It's a dream for optimists and, frankly, a nightmare for traditional value investors.
So the primary value proposition isn't about revenue today. It's really about the future and how they plan to get there.
Absolutely. Rigetti's primary value proposition lies in that full-stack, integrated model combined with their unique and, importantly, patented modular approach to scaling.
The chiplets again.
Yep. They believe controlling the end-to-end process allows for faster innovation. Their multi-chip processor technology is their answer to the fundamental scalability challenge in quantum computing. They want to link smaller, high-quality QPUs together.
And that 99.5% fidelity achievement.
That is the most powerful proof point for this core strategy to date. It shows the modular approach can work and work well.
Let's zoom out a bit then. What's happening in the broader quantum computing industry right now? Is it really at an inflection point, as people say?
Yeah. It absolutely feels like it. 2025 is shaping up to be a critical year. There's accelerating investment and a clear shift from just theoretical promise towards early commercial deployment.
People are starting to actually use these things, or try to.
Exactly. And the long-term growth forecasts are truly explosive. We're talking projections of the global market growing from maybe $2 billion in 2025 to over $17 billion by 2034. Some estimates go even higher, like $97 billion by 2035.
Wow. That's a compound annual growth rate?
Well over 30%. Rigetti's own management anticipates a $15–30 billion annual market opportunity by the 2030s or 2040s.
That's massive potential. What are the key trends defining this inflection point that Rigetti needs to align with to capture some of that?
There are 3 major trends really shaping 2025. First, a crucial shift away from just focusing on qubit count.
More qubits isn't always better.
Right. The focus is now on qubit quality. That means gate fidelity, like Rigetti just improved, coherence times, how long a qubit can reliably hold information, and error correction, which is crucial for fixing inevitable quantum errors.
Okay, quality over quantity. What else?
Second, the rise of hybrid systems, quantum and classical computers working together, as you mentioned. And third, investment is becoming more strategic and concentrated. You're seeing fewer but larger funding rounds going to the perceived leaders in the field.
And Rigetti seems to be aligning well with those trends, especially with their recent fidelity achievement and the modular approach for scaling.
Precisely. Their focus on achieving that 99.5% fidelity and validating their modular architecture directly addresses the market's demand for higher quality and better scalability. It aligns perfectly with these key industry shifts.
But who are the major players in this intense competitive landscape? Because Rigetti isn't alone in this race, far from it.
No, it's a diverse and frankly fierce field. Among direct public competitors, you have D-Wave Quantum, ticker QBTS.
You do annealing, right? A different approach.
Exactly. Quantum annealing. It's a specialized method, great for optimization problems like finding the best route for logistics rather than general-purpose calculations. They have more commercial traction currently, but their approach is generally seen as less versatile than Rigetti's gate-based model.
Okay. Who else?
Then there's IonQ, ticker IONQ. They're a leader in trapped ion technology.
Using charged atoms.
Right, individual charged atoms suspended by lasers. They're renowned for their high-fidelity operations, very accurate qubits, though the operations themselves can be slower than superconducting qubits, and IonQ generally appears to be in a stronger financial position than Rigetti.
And what about the tech giants? Google, IBM. They're always a shadow over any emerging tech field.
They are Rigetti's most formidable long-term threats, no question. Google and IBM are pursuing the same superconducting qubit technology as Rigetti.
Same tech.
Yep, but with vastly greater resources, huge R&D budgets, and massive patent portfolios. It's a David versus Goliath situation in some ways.
And private companies.
There are also well-funded private competitors like Quantinuum. They're a major player in trapped ion technology like IonQ, with a valuation maybe exceeding $5 billion now. And they're backed by Honeywell, so serious competition.
So Rigetti, with its market cap around $3.71 billion and just $9.21 million in trailing 12-month revenue, that's compared to IonQ at $10.4 billion market cap and maybe $25 million TTM revenue, or D-Wave at $4.76 billion cap and $8.83 million TTM revenue.
That financial scale difference is significant, yeah. It really highlights their, well, precarious position as a pure play trying to compete.
What about regulations? Anything changing there?
The regulatory environment is still nascent, but it's definitely evolving. The U.S. has classified quantum tech as critical, which imposes export controls. That could hinder international sales down the line.
But there's also an opportunity side of regulation, right, with post-quantum cryptography.
Yes, exactly. The looming threat that quantum computers pose to current encryption standards. It's a big deal. NIST, the standards body, is working hard to standardize new post-quantum cryptography PQC algorithms.
So quantum creates the problem, but maybe help solve it too.
Precisely. This whole PQC transition creates a significant market opportunity for quantum companies that can contribute to developing and implementing these new quantum-safe solutions. It turns a threat into a potential commercial need.
It sounds like the barriers to entry in this industry are incredibly high.
Yeah.
It's not just about money, is it? It's about finding literal quantum geniuses.
They are exceptionally high barriers. First, the extreme technical complexity. You're dealing with quantum decoherence, error correction, just scaling the things up. It's incredibly hard physics and engineering. This demands world-class talent, which is, frankly, incredibly scarce globally.
A real talent war.
Absolutely. Second, the capital requirements are intense. Hundreds of millions, if not billions, are needed for specialized facilities like Rigetti's Fab 1, the cryogenic equipment to keep these things super cold, and just ongoing R&D. So yeah, profound talent shortage, huge capital needs, bleeding edge engineering, very tough field to break into.
So, with all that context, what is Rigetti's actual competitive advantage? What's their unique moat in this cutthroat environment?
Well, their brand strength as a pioneer is a factor. They're often mentioned alongside Google and IBM, which helps. But that's a soft advantage. It could be fleeting.
Right.
Cost advantages. None currently. Fab 1 aims for future cost efficiency and speed if manufacturing scales. But that's a big if, and it's not a present advantage. Network effects around their software. Minimal right now. The ecosystem is still nascent.
So what's the core moat then?
It really comes down to their unique assets and capabilities. Their core moat, I'd say, is built on two main things. First, that vertically integrated full-stack model. In-house chip design, Fab 1, software, cloud. It allows for potentially rapid iteration and optimization.
Control over the whole process.
Right. And critically, second, their proprietary and patented modular architecture. That multi-chip processor technology, the chiplets, that's their core IP for scalability. And the 99.5% fidelity on the 36-qubit modular system, that is the most significant validation of this core competitive advantage to date. It shows their bet might be paying off.
Okay, that wraps up the business side. Now let's shift gears in Chapter 2. Management evaluation. We need to look at the team leading this quantum charge specifically, how they're steering the ship, and, importantly, managing their resources.
Right. And Rigetti's leadership team has actually undergone a pretty significant transformation recently. Back in late 2022, early 2023, there was a definite shift. They moved from being more of a founder-led research organization—
Focus on the science.
Exactly, to becoming a more commercially focused public company.
And who's leading that charge now? What kind of experience do they bring to this very specialized field? Because it's not just tech, it's deep tech.
The key figure is Dr. Subodh Kulkarni. He took over as president and CEO in December 2022.
Kulkarni, what's his background?
He's a seasoned semiconductor veteran. We're talking over 3 decades of experience. And crucially, he was previously CEO of a publicly traded tech company called CyberOptics.
Ah, so he knows semiconductors and public markets. That seems relevant.
Very relevant, especially for scaling complex technology manufacturing and navigating the demands of being a public company. He's supported by CFO Jeffrey Bertelsen, who actually came with him from CyberOptics, and CTO David Rivas.
It sounds like the board made a deliberate choice there, bringing in experienced operators after the SPAC deal and the founder's departure.
It certainly looks that way, a move towards more disciplined, perhaps milestone-driven execution.
And that 99.5% fidelity milestone we keep mentioning, that's the first major technical validation under Kulkarni's leadership, isn't it? That must be a huge feather in their cap.
It is, absolutely, and it certainly suggests this new team is capable of executing on its stated technical goals. Now, regarding communication transparency and ethical reputation—
How are they doing on that front?
Generally, Rigetti maintains standard public communication. Quarterly earnings calls, presentations at conferences, interviews. Dr. Kulkarni has been reasonably transparent, acknowledging the company is still in an R&D stage, and even mentioning external factors like potential tariffs as a concern down the road.
Okay, sounds fairly standard. But when we look under the hood, are there any signals that might complicate this seemingly positive picture, especially regarding management's own actions? I think you mentioned insider trading earlier.
You're right to bring that up. A deeper analysis reveals a, significant and frankly troubling disconnect between the public narrative and private financial actions by insiders.
A disconnect. How so?
The pattern of insider trading is overwhelmingly one-sided. In the past 6 months, there have been 11 open market sales by insiders and 0 recorded purchases.
11 sales and 0 buys. That's stark. What kind of scale are we talking about here in terms of dollars? Is it just token amounts?
Not at all. The scale is substantial. The CEO, Subodh Kulkarni, sold 1 million shares for an estimated $12 million.
$12 million. Wow.
The CTO, David Rivas, sold approximately 671,600 shares for around $5.8 million. And the CFO, Jeffrey Bertelsen, sold around 231,250 shares for roughly $2.7 million.
Okay, that is a staggering amount of selling.
Yeah.
Millions upon millions, especially when the stock is up over 1,000% in the past year, and they just did that massive dilutive ATM share offering. What's the significance of that for us, the listeners?
It's a considerable red flag for any potential investor, you have to say. For the top executives who are publicly championing the company's bright future and hitting these tech milestones, to be selling millions of dollars worth of their personal stock right after the stock runs up and they raise more money diluting shareholders.
It doesn't look great.
It suggests that, in their personal view, the stock's current valuation might be full, perhaps even stretched, or maybe that the risk-reward profile from here is skewed enough to warrant significant personal de-risking, this consistent and heavy selling pressure from the very highest levels of the company. It's often seen as a more potent indicator of their true sentiment than any press release or optimistic public statement.
Definitely something for listeners to weigh heavily. Okay, moving to capital allocation. How is Rigetti investing the money they do have and the money they're raising? Where's it going?
Their strategy seems squarely focused on survival and innovation right now. The vast majority of capital is being plowed into R&D. That's for hitting their technology roadmap goals, improving processor performance, scaling up qubit counts, and also into CapEx, capital expenditures, for expanding and upgrading their Fab 1 facility.
Makes sense for an R&D stage company. What about that strategic partnership with Quanta Computer? Was that just about money or something more strategic?
That collaboration with Quanta Computer, which they signed back in February 2025, looks like a masterful piece of capital allocation, honestly.
How so?
It's more than just funding. It's a deep strategic partnership. It secures over $100 million in mutual investment commitments, plus a $35 million direct equity investment from Quanta into Rigetti.
So cash plus commitment.
Right. But crucially, it also provides access to the manufacturing expertise of a global Fortune 500 leader like Quanta. That could be absolutely vital if Rigetti ever needs to scale up production significantly in the future.
Access to manufacturing know-how? Interesting. What about M&A? Buying other companies?
Doesn't seem to be a focus. Rigetti hasn't engaged in any significant acquisitions recently. Their focus remains internal development and partnerships like the Quanta deal.
And share buybacks or dividends? I'm guessing that's a firm no for a company at this stage.
You'd guess right. As a pre-profitability, high-growth, capital-intensive company, Rigetti doesn't pay dividends and has no history of share buybacks. That's entirely appropriate for where they are.
So how do they fund themselves?
Their primary method of funding is through issuing new equity, selling more stock, like that $350 million at the market or ATM offering they did in June 2025. The unavoidable consequence of that is significant and ongoing dilution for existing shareholders. Your slice of the pie gets smaller.
Okay, so return on invested capital, or ROIC, probably isn't a useful metric here, given all the losses and the constant need for new capital. What should we look at instead to see if their capital is being well spent?
Correct. Standard ROIC calculations for Rigetti are deeply negative. Numbers like -25%, an additional 1% get thrown around, but they're basically meaningless because the net operating profit after tax is negative.
Most not useful.
Not really for judging financial performance at this stage. A more relevant, though admittedly qualitative measure might be something like return on R&D spend.
And how are they doing on that metric?
Well, on that front, the 99.5% fidelity milestone is a positive indicator. It demonstrates that the capital they're deploying into R&D is producing tangible technical results. Progress is being made.
But the financial return?
The ultimate financial return on that R&D investment, however, remains distant and highly uncertain. It's a long, long way off.
All right, let's move on to Chapter 3, Financial Analysis. We've talked about the tech and the management. Now let's dive into the core numbers. You mentioned Rigetti's financial profile is characteristic of a well-capitalized pre-commercial R&D venture, strong balance sheet, but deeply unprofitable income statement, and significant cash consumption.
That's the picture, yes. As we said, mid-July 2025, Rigetti's market capitalization is hovering around $3.71 billion. Again, this valuation reflects massive future growth expectations, not current performance.
And the revenue trends?
They're slow and volatile. Revenue actually peaked back in 2022 at $13.1 million. Then it declined to $10.8 million in 2024.
And it got significantly worse in Q1 2025, didn't it? I remember that 52% drop.
Indeed, Q1 2025 revenue was just $1.5 million, a 52% year-over-year decrease. That really highlights the unreliable nature of their current contract-based income stream. It's not predictable growth.
And profit margins, I assume they're deep in the red.
Oh, yes. Deeply negative across the board. Trailing 12-month operating margin is around -799%.
-800%.
Roughly, yeah. And the net profit margin is even worse, an astonishing -1,494%.
-1,500%. How is that even possible?
It means their operational costs and R&D spending vastly exceed their revenue. They're spending far, far more than they're making. Net losses can also be magnified by non-cash charges, like changes in the value of warrant liabilities, which hit them hard in 2024.
So they must be burning through cash at an alarming rate. How much are we talking about?
Consistently negative free cash flow, yes. That's the cash burn. For Q1 2025, the cash loss from operations and investments was about $16.2 million.
$16 million burned in one quarter.
Right. And this persistent cash outflow is exactly why they continually need to raise capital through those equity offerings we discussed. They need fuel for the furnace.
Okay, so huge losses, big cash burn. But despite all that, you said earlier their balance sheet is actually quite strong, at least for now. That seems like a contradiction. How can that be?
It is strong, relatively speaking, and this is a direct result of their capital-raising strategy. They have a clear history of unprofitability, and they expect losses to continue for the foreseeable future.
No surprise there.
But their debt-to-equity ratio is very low, around 0.04 last check. This is a strategic choice. They've chosen to fund the company almost entirely with equity, selling stock, rather than taking on debt. This minimizes financial risk from interest payments and avoids restrictive debt covenants, those conditions lenders put on loans. They even prepaid a loan from Trinity Capital.
So low debt. What about their current ratio? That measures short-term liquidity, right?
Yeah.
Ability to pay near-term bill.
Exactly. And their current ratio was exceptionally high in Q1 2025 at 18.82.
18. That's really high.
It is. It indicates very strong short-term liquidity, meaning their current assets, like cash, far exceed their current liabilities, bills due soon. This strength comes almost entirely from the large pile of cash and investment holdings they built up from recent equity sales.
So the balance sheet health is bought with shareholder dilution.
Precisely. They don't pay dividends, naturally, because every dollar is needed for R&D and just keeping the lights on. So the overarching story here is a well-capitalized R&D venture. Their balance sheet health, high cash, low debt, comes directly from raising hundreds of millions through equity offerings.
Which provides that critical multi-year cash runway we talked about.
Yes, stability is purchased with shareholder dilution. The core challenge remains. Can they translate that runway and the recent tech progress into a sustainable, profitable business before the cash runs out again?
The multi-billion-dollar question. Okay, let's talk valuation analysis. You said valuing a company like Rigetti with conventional metrics is incredibly challenging.
It really is, because the price is based almost entirely on future potential, hope, speculation, not present fundamentals.
I imagine priced earnings isn't meaningful. With negative earnings, it would just be NM, not meaningful.
Correct. PE is useless here. So you have to look at something like price to sales, PS, and Rigetti's trailing 12-month PS ratio is, well, it's extremely high, around 402.5x.
400 times sales.
Yes. Imagine paying over 400 times a company's current yearly revenue for its stock. That's where Rigetti is trading. It just screams future, 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 and highlights how much belief, not current cash flow, is baked into that stock price.
So if you were to try and use an intrinsic valuation method like discounted cash flow or DCF model, which tries to estimate a company's true worth based on future cash, what would that look like for Rigetti? I assume it's tricky.
Extremely tricky, and really more of an educational exercise here. A DCF model values a business based on its projected future free cash flows. For Rigetti, with no history of positive cash flow and a very uncertain, distant path to profitability, any DCF analysis is highly speculative.
What kind of assumptions would you need to make?
You'd need to assume extremely high multi-stage growth rates. We're talking potentially triple-digit revenue growth starting in the late 2020s, and then sustained positive free cash flow maybe 5-7 years out, maybe even longer. And crucially, you'd need a very high discount rate.
Why high discount rate?
To account for the extreme risk involved, maybe 15-20%, or even higher, reflecting the chance they never reach profitability or their tech gets leapfrogged.
And what would such a model likely estimate as Rigetti's intrinsic value? Does it even come close to the current stock price, around $12.77?
Honestly, any credible DCF model under these conditions would almost certainly produce an intrinsic value significantly below the current market price. Some analyses based on plausible, though still optimistic, assumptions might put the value as low as, say, Siverdi Italian at 56 cents per share.
56 cents, compared to nearly $13.
Yeah. It just highlights the profound chasm that exists between a valuation based on current financial reality and one based purely on future technological optimism and market hype.
Wow. Okay, that concludes part 1. We've looked at the business, the management, and the financials. Now let's move to part 2, market dynamics and outlook, starting with chapter 4. Market sentiment.
Right. So we've seen the kind of grim numbers on profitability, but also their impressive cash runway. That's the internal picture. But how is the outside world, Wall Street investors, the media reacting to all of this, especially with that big tech breakthrough news?
Good question. What's the vibe out there?
Well, interestingly, Wall Street analyst sentiment is surprisingly bullish on Rigetti. It contrasts sharply with some of the financial realities and the insider selling we just discussed.
Bullish. How bullish?
The consensus among the analysts who cover the stock is a strong buy. Based on the sources, there were 4 positive ratings and 0 sell ratings in the past 6 months.
4 buys, 0 sells. Okay. And what about their price targets? Are they expecting a huge jump from the current price?
The median 12-month price target among those analysts is $15. You have firms like Cantor Fitzgerald, Needham, B. Riley, Benchmark, all setting targets generally around that $14, $15 level.
So, suggesting maybe modest near-term upside from the current $12.70 share price.
Yeah.
What are they basing that optimism on?
Likely confidence in the company hitting milestones on its technological roadmap, like the fidelity achievement and belief in the long-term market opportunity.
And the media reaction. That 99.5% fidelity announcement certainly lit up the news.
It did. It had an immediate, overwhelmingly positive impact. Headlines like, Rigetti shares jump as 36 qubit quantum system breaks fidelity record definitely drove the stock higher that day.
So the general media tone is...
It's a bit of a blend, really. There's excitement about the pioneering tech and the transformative potential of quantum computing, but there's also usually a note of caution about the speculative nature of the investment, the lack of profitability, and the intense competition.
Okay, so analysts, bullish, media mixed but excited by breakthroughs. What about other market indicators? Short interest. That tells us how many investors are betting against the stock, right?
Exactly, and short interest is a critical indicator here because it shows just how divided the market is on Rigetti.
So what's the short interest looking like? Are a lot of people betting on a decline?
It's high, very high. As of the end of June 2025, the data showed 57.01 million shares were sold short. That represents almost 20%, 19.92% of the company's float, the shares available for public trading.
Nearly 20% of the float is short. That's substantial. What about days to cover?
Based on average daily trading volume around that time, it would take short sellers approximately 1.59 days to buy back all those shares to cover their positions.
Okay, so a significant number of shares short, but not an extremely long time needed to cover. Still, that 20% figure. This truly makes it a battleground stock, doesn't it?
It absolutely does. It means a large and likely sophisticated group of investors is actively betting that the stock price will decline significantly. This creates a fascinating dynamic. You have the bulls, the analysts, the tech news followers focused on the long-term disruptive potential. And then you have the bears focusing on the unsustainable cash burn, the extreme valuation, and crucially, that consistent insider selling we talked about.
It's a tug of war.
Definitely. And this high short interest also creates the perfect conditions for a potential short squeeze.
Explain that quickly.
If there's more positive news, like another tech breakthrough, it can force those short sellers to panic and buy back shares quickly to limit their losses. That rush of buying can rapidly drive the stock price much higher, much faster than fundamentals might justify.
Got it. Squeeze potential is there. And technically, how's the stock doing on the charts? Moving averages?
Looking at the technicals around mid-July 2025, the stock was trading above its 50-day simple moving average, which is around $11.85. That's generally seen as a positive sign for short-term momentum. It had crossed above it back on June 24th.
And longer term, the 200-day.
It was trading well above its 200-day simple moving average, which sat around $8.45. Even more significantly, the 50-day SMA was also above the 200-day SMA.
Ah, the golden cross.
Exactly. That's often interpreted by technical analysts as a strong, long-term bullish signal. So the technical picture at that moment looked quite positive despite the fundamental concerns.
Interesting mix of signals there. Okay, let's move to Chapter 5. Ownership structure. Now let's zoom out a bit further and look at who actually owns Rigetti. What's the ownership structure like, and what does it tell us about investor confidence or lack thereof?
Right. Who holds the shares? Institutions like mutual funds, pension funds, hedge funds own approximately 32–34% of Rigetti shares. That's a decent chunk, but not overwhelming.
And who are the top holders? Any big names placing bets?
The very top holders are dominated by major asset managers that offer index funds. Think BlackRock, the Vanguard Group, State Street Corp. They hold significant positions like 5.3%, 5%, 2.8% respectively, largely because RGTI is included in various market indices they track.
So a lot of passive ownership. But what about the active managers, the ones making deliberate bets? Are they buying or selling, given all the volatility in the bull-bear arguments?
That's where it gets really interesting again, and it reinforces that battleground stock idea we just discussed. Looking at activity in Q1 2025.
What did you see?
You saw some big active managers becoming more bullish. State Street increased its position. Unicom Systems made a massive move, increasing its holding by over 1,200%. BlackRock, Vanguard, Morgan Stanley also added shares.
There's some big players were buying in.
Yes. But on the flip side, you had significant selling from other sophisticated investors. American Assets Investment Management, for instance, completely liquidated its entire position of 7.2 million shares.
Oh, everything. Wow.
And Invesco sold off almost its entire holding, about 97.6% of it. This shows a really deep division among sophisticated institutional investors. Some are clearly doubling down on the long-term potential, while others looked at the situation and decided to head for the exits fast.
Very divided street. Now, what about insiders themselves? The management team we talked about earlier, Kulkarni, Rivas, Bertelsen. How much of the company do they personally own, and are they buying or selling their own shares? We touched on the selling, but what's their ownership level?
Insider ownership is actually quite low. Estimates put it between 0.83% and 1.08% of the total shares outstanding.
Around 1% or less.
Yeah, which means relatively little of the personal wealth of the top management team is tied directly to the stock's performance, compared to founders or executives at other companies, perhaps.
And their transactions.
As we highlighted earlier, and it bears repeating because it's significant. Insider transactions over the past year, and especially concentrated in the last 6 months, have been exclusively sales. There were no recorded open market purchases by insiders during that period.
Only selling, no buying, from the people who know the company best. That remains a major bearish indicator that really can't be ignored when you're assessing the stock.
Absolutely. And regarding ownership concentration overall, it's not highly concentrated. The shares are fairly dispersed among various institutional holders, index funds, and retail shareholders. This means no single active entity has overwhelming control, which can make the stock more susceptible to broad market sentiment shifts and volatility.
Okay, that ownership picture is definitely mixed, leaning maybe a bit worrying with the insider activity. That brings us to a really critical part of our deep dive. Chapter 6, Risk Assessment. Let's frame this as a SWOT analysis, looking at Rigetti's strengths, weaknesses, opportunities, and threats.
Sounds good. Let's start with the strengths. What are Rigetti's core internal competencies?
Well, first and foremost, it's their technology, right? Pioneering superconducting qubit technology with that validated proprietary modular architecture of the chiplets. That 99.5% fidelity is a key strength.
Agreed. Second major strength is their vertically integrated model, including Fab 1. In theory, this allows for faster innovation cycles and better control compared to relying solely on external foundries.
And third,
their balance sheet, surprisingly. Having approximately $575 million in cash and equivalents and virtually no debt, thanks to those equity raises, provides a crucial multi-year cash runway. It mitigates immediate bankruptcy risk.
And finally, maybe their demonstrated ability to actually execute on complex technical milestones, like that fidelity record.
Yes, that's a strength too. It shows they can deliver on the science, at least sometimes.
Okay, those are the positives. But those strengths are weighed against some pretty significant weaknesses, aren't they? Especially on the financial side.
Absolutely. The weaknesses are stark. Number one, the financial picture. A history of significant operating losses and high cash burn, with no clear, predictable path to profitability yet identified.
Weakness, too.
Their revenue streams. They're volatile, dependent on lumpy government contracts, and have even been declining recently. This raises serious concerns about the reliability and scalability of their current business model.
And number three, something we keep coming back to.
The governance issue, that heavy and consistent pattern of insider selling by top executives. It directly undermines confidence and contradicts the bullish public statements.
Any other major weaknesses?
Maybe their history at times of missing publicly announced roadmap targets. That can introduce skepticism about future execution, even with recent successes.
Okay, clear weaknesses. Despite those, the opportunities for quantum computing in general, and for Rigetti within that massive future market, seem immense.
They are indeed. The biggest opportunity is simply the enormous total addressable market, or TAM, for quantum computing. Those multi-billion-dollar industry forecasts represent a huge potential for exponential growth if Rigetti can capture a meaningful share.
Well,
That strategic partnership with Quanta Computer is a major opportunity. It provides not just capital and validation, but potentially crucial access to world-class manufacturing expertise for scaling up.
and market needs.
There's growing demand from both government and enterprise sectors, driven by things like the need for post-quantum cryptography, PQC, and the potential for quantum to solve complex optimization problems in various industries. And then there's the synergy with AI.
How so?
The potential for quantum computing to become a key enabling platform for accelerating certain types of AI calculations. That's another huge potential opportunity down the road.
So, massive potential upside. But on the flip side, what about the threats? Who's trying to cut Rigetti off at the knees, or what external factors could derail them? Let's start with general external challenges.
The competitive landscape is arguably the biggest threat. As we discussed, they face intense competition from deep-pocketed tech giants like Google and IBM.
Who have way more resources.
Exactly. And they're pursuing similar superconducting technology. Then there's competition from other well-funded pure plays like IonQ and Quantinuum, who are using alternative technologies, trapped ions, that might prove superior in the long run.
So a constant risk of being leapfrogged.
Absolutely. There's a significant risk of technological obsolescence if a competitor makes a sudden breakthrough. Quantum research cycles are rapid, maybe 18-24 months for major advances.
Other threats.
Operational risks are also significant, potential supply chain constraints for highly specialized components, and that severe global talent scarcity in quantum physics and engineering we mentioned. Finding and retaining the right people is a constant battle.
Now, let's consider the impact of key macroeconomic factors, things like inflation and interest rates. How do those impact a company that's still burning cash like Rigetti?
Those are definite headwinds in the current environment. High inflation can increase operating costs. More importantly, rising interest rates increase the cost of capital. It makes future funding rounds potentially more difficult or more dilutive for unprofitable companies.
And it affects valuation too, right?
Critically, yes. Higher interest rates increase the discount rate that investors use to value future earnings. For a highly speculative stock like RGTI, whose entire value proposition is based on distant future profits, a higher discount rate puts direct downward pressure on its theoretical present value. It makes those far-off hopes worth less today.
And finally, any specific geopolitical factors that could pose a threat.
CEO Carney himself has acknowledged one potential issue: tariffs. He mentioned that potential 30–40% tariffs on critical components sourced from Europe or Asia could negatively impact their operating expenses, especially if they try to scale up manufacturing.
And potentially reciprocal tariffs.
Yes, there's always the risk of reciprocal tariffs hindering their ability to sell quantum systems or cloud services internationally, which could limit their market access down the line.
Okay, that's a comprehensive look at the risks. That brings us to our final chapter, Chapter 7, Conclusion.
All right, let's try to synthesize all of this.
We've covered a lot of ground, unpacked a huge amount of information on Rigetti. It's time to bring it all together. Let's start with the bull case. Sum it up for us. Why would you invest in this company right now despite the risks?
Okay, the bull case, in essence, rests on 4 key pillars. First, their position as a technology leader, arguably, in superconducting qubits. They have that proprietary, scalable, patented modular architecture, and it's now validated, at least initially, by the impressive 99.5% gate fidelity achievement.
Pillar 2.
It's a pure play investment opportunity. If you believe in the massive exponential growth potential of the quantum computing market, Rigetti offers direct exposure. Unlike investing in a diversified giant like Google or IBM,
Pillar 3.
they are strongly capitalized, at least for now. That approximate $575 million in cash, with no debt, provides a multi-year runway thanks to the recent financing. This mitigates the immediate risk of them running out of money tomorrow.
And the 4th pillar.
That strategic partnership with Quanta Computer. It's not just about the money, it provides significant validation and crucial access to world-class manufacturing expertise, which could be key for future scaling.
Okay, that's the optimistic view.
Yeah.
Now, let's hear the bear case, arguing against an investment in Rigetti. What are the biggest red flags that should give investors pause?
The bearish case is equally compelling, maybe even more so based on fundamentals, and it centers on financial and governance concerns. First, and perhaps most importantly, they have no viable business model yet.
Still an R&D project financially.
Pretty much. It's characterized by massive and sustained cash burn, consistent operating losses, and that unreliable, sometimes declining R&D contract revenue. There's no clear line of sight to sustainable profitability.
Bear case point 2.
The extreme valuation, trading at over 400 times trailing sales. That prices in not just success, but decades of flawless execution. It makes the stock exceptionally vulnerable to any setbacks or delays.
Point 3, the one we keep hitting on.
The heavy and consistent insider selling by the CEO, CTO, CFO. It directly contradicts the public bullish narrative and raises serious questions about their own conviction in the long-term value of the stock at these prices. It's hard to ignore.
And the final point for the bears.
The intense competition. They're up against vastly better resourced tech giants pursuing the same technology and nimble, well-funded pure plays developing potentially disruptive alternative technologies. The wrong of being outspent or technologically leapfrogged is very real.
So just to hammer home that valuation summary one last time,
Yeah.
any attempt at an intrinsic valuation using discounted cash flow is highly speculative.
Extremely speculative. You have to make heroic assumptions about growth decades into the future. And even then, such models invariably produce an intrinsic value maybe as low as 56 cents, maybe a bit higher, but still, that is just a small fraction of the current market price.
Showing that profound disconnect again.
Exactly. The stock's price isn't anchored to current financial reality, it's floating on future hopes.
So let's get to the concluding outlook. What's the bottom line on Rigetti Computing? Considering everything we've discussed, the tech, the losses, the insiders, the market.
Here's the bottom line, I think. Rigetti Computing, RGTI, is the archetypal high-risk, high-reward investment, maybe even extreme risk, extreme reward.
A real roll of the dice.
In many ways, yes. The current share price, around $12.77, is fundamentally detached from any conventional measure of current financial performance or intrinsic value. An investment in RGTI today is essentially a venture capital style bet.
A bet on what, specifically?
A bet that the company can successfully execute its ambitious technological roadmap, navigate the intense competition, eventually figure out a profitable business model, and emerge as a commercial leader in the quantum computing industry. Probably a decade or more from now.
So while Wall Street analysts have those bullish price targets around $14, $15, suggesting some modest near-term upside, that optimism needs to be heavily weighed against the significant bearish signals we've outlined.
Exactly. That huge chasm between the market price and any fundamentally derived intrinsic value, the extremely high short interest indicating significant bearish bets, and that unmistakable pattern of heavy insider selling. These are all factors that warrant extreme caution, maybe even skepticism.
So the investment case really boils down to belief.
It hinges entirely on an investor's belief. Belief that today's impressive technical milestones will actually translate into a dominant, profitable commercial enterprise far down the road. And crucially, belief that this distant potential isn't already more than fully reflected, perhaps even over-reflected, in the current high stock price.
That brings us to our final provocative thought for you, the learner. Reflect on this unique challenge. You're looking at investing in a technology poised for potentially transformative impact, something truly world-changing.
Yeah.
But it's so far from commercial profitability right now.
How do you assess that?
What does it take for you to confidently assess a company where the fundamentals, the numbers, scream warning, but the technological breakthroughs, the science, spark hope? How do you reconcile impressive technical achievement with questionable financial viability in what is undoubtedly a very, very long game? Something to think about.
Definitely.
If you found this deep dive valuable, we invite you to like and subscribe to the Stock Analytics AI YouTube channel. Remember, members get priority deep dives on tickers. It's just $4.99 a month. And over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And if you just want a one-off deep dive on a specific company you're interested in, drop us a super thanks on YouTube.
That's right.
And the necessary disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us on this deep dive into Rigetti Computing. Keep digging, ask questions, and stay well informed.